Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic, getting started with stock investing. I am your host, Kevin Horner. I want to thank you for joining me this afternoon. Today is an opportunity for us to dive a little deeper into the breakdown and allocation of a modeled portfolio for those of us investors who might be looking to expose money to the market over a long-term window of time. Commonly, many of you are familiar with me discussing and bringing to the topics here trade ideas, trade concepts. Well, today is going to move away from trading and more in line with investing, working towards building that modeled portfolio, referencing a tool we have available to us in Schwab.com called the Portfolio Checkup tool, which will enable us to kind of manage and see how our portfolio is allocated as we move forward throughout each month. So that's the goal for today. We've done this in the past, but I have spent some time building that portfolio so that we've got something to actually look at. So I hope that if you've seen the Portfolio Checkup tool previously, in this class in particular, I hope that this one will kind of highlight the merit of this tool perhaps a little more clearly for you all today. Now, I want to say hi to all of you here. I see many familiar names, of course, Eva and Lawrence, Dragon Rider, Jay Richardson, Mighty Mouse, Will. It's great to see all of you. Thanks for being here. Eva, we will address your question as it relates to the Dow Industrial Average and United Health today as well. We'll try and start off with that before we really get into the fun stuff. Now, remember, we have Mike Fairborn available in chat as well. He'll answer questions that I'm unable to get to within the discussion, but I'm happy to bring those questions in as much as I can. But feel free to post in there for the duration of our show. Remember, we go about 40 to 45 minutes. I'll hit you with some disclosures, and then we'll move into the important details. Remember, our conversation is exclusively for your information and your education. We do not make recommendations here. We're not endorsing a detailed approach to trading the market, more specifically endorsing the idea that long-term investing suggests we get started as soon as possible and start having that money in the market. The truth of the matter is that the idea of staying invested for the long haul is one that many in the investing world believe in. The idea that time in the market matters much better or much more than working to time your entrance to the market. That latter part, timing that entrance, becomes very, very sticky and difficult to accomplish. In truth, if you're investing for a very long window, think 15 years or longer, typically then it doesn't matter when you put that money together, put that money into the market. Was it at the absolute low of a given year? Was it at the absolute peak of a given year? Commonly, that doesn't matter. So just keep that in mind as it relates to our discussion here this afternoon. Now, we are going to cover price to earnings ratio, everybody. That's going to be one of the very first slides we talk about, but I want to take a quick second before we do so. I'm going to bring us back to the Thinkorswim desktop application, and I wanted to try and answer Eva's question about United Health, and it's not so much about United Health as it is more specific to the impact it might be having on the Dow Industrial Average. So let me put the DJI into the platform here. You can see the chart. You could also see that we've come down a bit from our peak up here, and we opened low today, but our candle is green because while we opened weekly, we have rallied this morning. Now, let me hide the existing market. I'm going to go ahead and launch another watch list, and I'm going to apply the current Dow 30 watch list, which we can find under public and Dow Jones Industrial Average. So that'll give us our Dow 30. Now, what some of you may already know is that the Dow 30 components, this indice, this average, is a price-weighted index, which means that it's calculated by taking the share prices of the constituents or the 30 stocks within the indice. We take that share value and add it all together, divide it by the 30 individual securities. We have an overall price, and essentially that defines how it's weighted. But that means that high dollar stocks like a United Health, I should say, was a much higher dollar stock previously trading over $600 a share, can absolutely have an impact. In fact, the larger dollar value per share, the larger impact on the index it will have. So United Health trading at $270 a share when in the beginning of April, it was trading over $600 a share. It has had a dramatic impact. But note here, it's not as though the Dow Industrials have struggled in that window, have they? I mean, if we look at where we were on April 7, the Dow or April 14, pardon me, I'm pointing to here, the Dow had made a peak before a brief pullback for 3 or 4 sessions. If we look at how United Health was acting in this specific period of time and go back to the same April 14 window, United Health was in the process of dropping dramatically and carrying lower, which I find a little bit interesting because, of course, the thought could very well be that this is hampering the industrials. But as you can see today, the industrials are doing relatively well, all things considered. So I think it is important to know that, yes, one of the 30 components of the Dow Industrial Average is having a very rough go of things. It's equally important to know why it's having a very rough go of things. That said, the impact to the portfolio, to the Dow 30 index, is certainly kind of limited in scope, as we can all see here, everybody, because we have the other 29 securities within that index carrying water for it at this time. So one of the great reminders, of course, is how an index acts, understanding the component breakdown, the percentage of allocation, et cetera. It's very important, but it's equally important to realize investing in broad groups like a Dow 30 component or an S&P 500 fund or something like that is part of the process of reduction to risk, right? If we're investing for the long haul, yes, we can choose individual stocks, as we often do in this particular segment, but choosing to work with funds in lieu of individual stocks is just one way that we can help to spread that risk out a little bit and diversify it out across the classes that we choose to work with. And I say classes, I'm talking classes of assets, your large caps, your small caps, or sector allocation, as we're going to be talking about here today. So I hope that helps out, everybody. Wanted to try and make sure we discussed it. Now, let's jump back to the slides here briefly and just to talk about some of these components that we want to be thinking about when we are allocating our funds. What we are going to do is just work through these 3 very briefly, because in the subsequent portion of this segment, we're going to bring up our modeled portfolio, our current example portfolio. We're going to see where we are not currently allocated properly, and we're going to look to expose money to those categories of the market. So that's going to take us out of Thinkorswim and into Schwab.com here in a moment, but we're going to get some familiarity with a little bit of the price to earnings ratio, what this stuff lets us know about, right? What it speaks to in terms of the ratio itself. The price to earning is really just a calculation of how many dollars it takes in terms of your investment to earn a dollar in earnings from the underlying stock. So a price to earnings ratio, for example, of 20 suggests that it cost me $20 to profit by $1 per investment in the stock. So a lower value in price to earnings is thought of as a more value-oriented position. For example, what we will frequently see as it relates to securities with high growth are stocks that have maybe more debt. These companies may not have low earnings price to earnings ratios. They may have very high price to earnings ratios. Those price to earnings ratios could even be negative if the company has not even achieved positive earnings results. That's a possibility as well. So recognizing that and understanding that maybe if I'm investing for long-term growth in a company that is not yet mature enough to show earnings, well, then I might have to give up price to earnings as a metric, right? I might not find any merit in price to earnings, and I might look at other more important details, like are they growing revenues, even if they're not growing actual earnings. So just one way to think about it, as you start to think about more in the vein of, say, value investing, securities that are very mature, maybe dividend investing companies that are going to provide you a payout on a quarterly or annualized basis, then you could start to look at stocks that are maybe more reasonable with a price to earnings ratio, as an example. Another thought process could be price to sales ratios. Price to sales ratios are going to be another way of evaluating companies. And again, a lot of the time when thinking about these groups, everybody, or these values, it's important to consider them. But what makes sense for consideration is, how do these ratios look relative to company peers? So you don't want to necessarily take stocks that are in technology and put them side by side with stocks that are in staples and evaluate things like price to earnings and price to sales or price to book. These are things that can be helpful for viewing stocks against their peer groups, but not outside of those peer groups. Okay. So I think that makes a lot of sense if we think about the process a little bit. Not everybody is going to build a list of investable securities based on ratios that fit within their comfort zone. But it may become a delineating factor when you have a series of stocks and you're wondering, all right, I've got 3 or 4 in this space and I'm going to pick 1 or 2. You might consider how these ratios look side by side and then go with the one that gives you the greatest amount of comfort. That might mean that in your portfolio, if you've determined that you're maybe a little bit aggressive, you might want to choose, as an example, a security. As you're devoting money to a given space, you might want to choose a security with a lower price to earnings ratio, something that seems to be a little bit more stable than one with a very high growth metric and perhaps a very high price to earnings ratio. So all thoughts that can be considered when allocating your funds a little bit. And then the third space, or the third metric that we've previously discussed, is price to book ratio. Of course, another one, but this one in particular can be thought of in instances where stocks are really undergoing dramatic drawdowns, because the price to book is talking about the true value of the stock if we were to eliminate all that is out there in terms of assets and liabilities. So, for example, if the company were to decide that they were no longer able to conduct business as a publicly traded entity, one of the concepts might be that they're going to go private, for example, or under a terrible scenario, they're going through a bankruptcy or something like that. The company itself might be valued at a certain dollar per share simply by the amount of assets they maintain, whether that be inventory or land or real estate beyond land, actual buildings and so forth. All of that can be built in to the price to book ratio. So some investors who have done the legwork, done the research, might find stocks whose prices are below their book value, and they would perhaps suggest, now this is not in any way a recommendation, obviously, but if you think about the book value of a stock being at $20 a share based on all assets, all liabilities, and you see the stock trading at a $15 price per share, well, then an investor who's looking for value might say, hey, there's opportunity here, simply because if this stock doesn't go away, well, then it's got to be valued at greater than $20 a share, because every dollar of assets they own is at least equal to $20 a share. So what is that doing? It's taking into account the value of all assets, all liabilities, and dividing it by the shares outstanding. That's simple. So is there true value if the company were to go belly up in the form of all of those aforementioned details? Okay, so those are some of the things you might consider when evaluating and determining which securities you might want to go with. Now we're going to jump back in, not back, but rather into Schwab.com from here. So what I'm going to take you to, we're on the account summary page here, everybody. Now I'm going to slide on down to portfolio performance. Now, portfolio performance for all of you is going to maintain some opportunity to monitor your valuations. How are things looking? What is my asset allocation? What is my rate of return relative to the risk I'm taking on? This is an excellent page for you. And I say for you because I can't show you these values as it relates to my example portfolio, but I am going to move into our portfolio checkup where I did build that example portfolio for us so that we've got some things to work through and look at here, which I'm excited to share with you because I think this will do maybe an improved job of really highlighting the reason that I like this tool so much, the reason this tool can be so helpful. So let's go just up to the upper right here, clicking on Go to Portfolio Checkup. And like I said, we've talked about this before, so I am going to put this into a link to this particular playlist right into the field here, into our chat. So you can look this up. I've even made note of it, portfolio checkup. It goes back about 3 weeks, 4 weeks or so. So if you wanted to dive a little deeper into it, you could watch that class as well. But what I wanted to highlight here was the steps that I've taken. First of all, I made some adjustments to my portfolio. I went to portfolio setup here and I added an external account. Now that's helpful for me so that I can show you what I want to highlight today. But for all of you, it can be very helpful as well. If you are utilizing this already and have not taken the steps to incorporate assets that you maintain at other firms, banks, etc., you can absolutely do that right here and do the incorporation, incorporate those dollars into your overall modeled approach. Very, very important because listen, if we determined that at Schwab, everything's hunky-dory, no concerns as you work through your model, but then you mention, hey, I'm sitting on $200,000 that's invested in CDs over here, that needs to be brought into the overall mix as either a conversational topic or one that helps you understand the true risk of your portfolio. Maybe perhaps if this were built into the portfolio, the details associated with that much cash or cash equivalents could tell you that you have reason to be a little bit more aggressive in your approach. So you have to give consideration to how everything is going. The more holistic you can be, the better suited your portfolio can be thereafter. So always try to be considerate of that. So I have, like I said, incorporated this account via the external link, and I am working with an aggressive model. So I'm going to go to portfolio analysis up here, and we are going to see that my current allocation is all yellow. It's just individual stocks. My hope is that yours might incorporate some blue, fixed income, perhaps a little bit of commodities. But you can see an aggressive modeled portfolio per the allocation needs to be very heavy individual stock or U.S. equities, essentially, right? And as you can see, there is about a 20% component of non-stock, even for an aggressive model. Now, as we move off of asset allocation, we're going to go to sector diversification. So in addition to being well diversified by investing in large cap, small cap, international, and cash, when we start thinking about the large cap, small cap breakdown of domestic assets here, we need to give consideration to whether we have a proper allocation relative to the S&P Global BMI Index. And that is the down below here, that is the bottom row. This is the allocation of the model. So that means we need to validate or determine that we have areas here that need to be addressed. Pretty clearly, we do not have any communications. We are missing in energy. We're a little overexposed in financials, a little overdone in tech, and a little bit overdone in utilities. Although when I ran this earlier, utilities wasn't included. So I'm wondering how we got utilities there all of a sudden, but nonetheless, we're not going to worry about that. Maybe I misspoke. So what we do want to do is take this knowledge and go into Thinkorswim and try and pick on some securities that'll allow us the chance to expose money to these sectors, get more in line with our process and our modeled approach. Now, I want to point out that we are getting the green arrow here because none of these individual sectors is out of balance by greater than 20%, which is what the highlighted detail here points out. So we will give an alert. You'll get a yield sign like the yellow yield here under quality. You'll get a yield sign if you have an investment section, a sector in this case, amongst the 11 sectors of the US market that is out of balance by greater than 20%. However, some investors might choose to keep this a little more in line and look at it like, hey, as long as I'm within 10%, I don't need to make adjustments. And if it's greater than 10, they might thereafter make an adjustment. So just a heads up on that. So let's take this knowledge into, before we go, in fact, I just wanted to highlight also equity concentrations, the way that it looks at those. This is highlighting your Schwab equity ratings exclusively. So please know that that's the only metric here that we're considering. Are they A, B, or C rated, in which case you're not going to have any detailed notifications. If you have F rated positions, you'll get those here. That would show up as an alert. So just a heads up in that case. And of course, I don't have any fixed income, but if I did, I would be happy to click on that for you there as well. So let's use this sector diversification to move over to Thinkorswim, and let's see if we can't find some stocks that'll suit our purpose here today. So we're going to bring up Thinkorswim, and I've got the scan tool available, ready to go. So what I've got here, everybody, is a fairly basic scan. What I went with is something that's going to let me to have exposure to the individual sector, but it's going to be stocks that are already in uptrends. So how did I define that? I went with a breakdown of first, the stocks have to be over $10 a share, which is probably going to be majority of stocks we find anyway in the S&P 500. Then I wanted to make sure that the stock's close is a last close above its 20-day moving average. So that's meaning we're in a short-term uptrend. And thereafter, I've also placed in a couple of other key components. Let me highlight this for you, everybody. I'm going to click on my pencil here, and you'll see that the two studies here, we have a 20 simple moving average that is greater than a 50. And then the second one I've got is a 50 simple moving average greater than a 100 simple moving average. So these are on daily charts. So that's a 20-day SMA above a 50 and a 50-day SMA above a 100 SMA. And the reason for that is that the likelihood is that if those conditions are met, then we have a stock in an uptrend, a series of higher highs and higher lows. And that's what we're striving for in terms of adding to the portfolio. It's, we certainly could be a little more generic or a little more remedial in our process. We could choose to look for stocks that are greatly down, as an example, trading near 52-week lows. But in truth, buying stocks that are in the process of establishing lows, still moving lower, and hoping that they bounce, that's not a process that I can really support. The idea of hope as your main process, not a big fan of that. So what I want to do is encourage the idea that if we are putting our money to work, we should be working with stocks that are already in favorable trends. Now, that doesn't mean they're trading at highs necessarily. It just means that they are in favorable trends over multiple windows of time. So because we've determined that we need a little communication, we need a little energy, we need a little industrials, let's first just take a quick peek at how my portfolio is broken down. This is my getting started with stock investing class. And as you can see, I have asked Thinkorswim to sort by the sector breakdown here. So I've got a little bit, very little of discretionary, a little bit of staples, healthcare, financials, tech, and others. Others really is energy. First Energy falls in like a combined or hybrid energy scenario. But we need some exposure, as we just learned, by looking at that portfolio checkup tool. So we are going to start with communications. So we're going to go back to that scan tool where I have this scan ready to go. We are in the S&P 500 specifically, and I am asking it now to intersect the S&P 500 with specifically communication services. So let's take a look at that. Now we're going to hit scan, and okay, we've got a few. Let's see here. We have, by the way, I've already built in the headers and the other details. So here's price to earnings ratio, here's price to cash flow, and here's price to book. So not to suggest that these are imperative details, but if we were to look at price to earnings, notice where Netflix resides, notice where EA resides, whereas a Take-Two is not currently earning on a positive basis, nor is Paramount Global. That might be a decision factor for some of you, okay? That's all I'm suggesting, not to say that that's how you have to do it, just a way that some investors might. And you might also decide, hey, for this space, I'm not going to care about price to earnings ratio. I'm only going to care about this. Whatever that is, please define that for yourself and then hopefully base your decisions on that properly. So maybe you're looking for a dividend yield, and the idea of a near 4% dividend here in AT&T could be appealing. Let's click on this 5, which is going to populate my chart for me, and let's see how AT&T looks. Well, it is true. We do have a series of higher highs and higher lows along the way in here. Some traders, even investors, would say that some action above this $25 a share has been favorable. A lot of the price action over the last couple months have been above $25 a share, so that might be something that some investors are considering here. It is making a very strong move today. All right, we got a lot of action happening in my example portfolio today. Not entirely certain why, I will point out, but it is going on nonetheless. So this is a possibility, right? If your goal was to have communications dollars, maybe to get some dividends from a position like this, perhaps AT&T is an opportunity. We could also go back and hit up. Let's see how EA and Charter look. Netflix might be a little too high in price. EA might look a little more appropriate given that it has, from a technical basis, it's broken out a little bit, and then it came back for a new test of the breakout level. That's a very common technical analysis 101 type thing to have happen in the midst of an uptrend like that. So you had a breakout, got all the way up to 160, came back to the 147 for a test and trying to move off of it. For some traders, if it closes today above the high trade from yesterday, that could be a step towards validating an interesting entry point. That would be the potential close above the high of a low day. This would be yesterday defined as the low day in this pullback if this holds. So that could be an opportunity here. So off of this, perhaps we could go ahead and utilize this as a means of exposing some money. Why don't we just put together a small trade here? 25 shares probably does a sufficient amount for us. I mean, 10 shares would be 1,500. So 20 shares would be about 3,000, and 25, a little bit more. So right in the wheelhouse of what we're trying to do in terms of getting some balances devoted to some of those individual spaces. So let's go ahead with a right click. We'll place a simple buy for my default is, that's 100,000 shares all of a sudden. We're going to need to fix that. We're going to go ahead and delete this, and I'm going to give you guys an idea as to how to fix that here in Thinkorswim. We go up to Setup and Application Settings, and then we're going to go to Order Defaults. As you can see, the limit, now this allows us to define this, by the way, based on your order type. So if I place limit orders and I don't want order defaults to be at 1,000 shares, because that's pretty substantial, you might prefer it be at about 25, and then order increments of 25 as well. That way, when you place the order, whether it be $1,000 a share stock or $100 a share stock, you're at least in a reasonable order entry. So let's go ahead, right click. Oh, sorry there, everybody. Right click and buy. There we go. Now I'm at 25 default with a limit price. Let's just make sure that limit is reasonable. It's a little bit off, so I'm going to use my slider down below. We'll go in at the mid around 149.50, and we probably get executed pretty quickly here for 25 shares. So just to read through, make sure we're getting exactly what we want. Hit send, and there we go. And then our monitored portfolio, let's see here. Oh, it's probably in my unallocated area, so let's make sure that I place it where I need it. There we go. So just right-click in the position and move to the proper group. There we go. All right, so eliminate that unallocated. There we go, everybody. All right, so now communications. I've got that exposure, okay? Yeah, John, it's a good question you have here about the portfolio performance in comparison with the S&P. The inclusion of dividends is going to be part of your overall value of the portfolio. As it relates to risk and return details, I would expect that to be part of the return process for you. The extent to which the breakdown is managed, though, I can't answer off the top of my head. The tool itself, if we're, for example, going into portfolio performance here, where we start breaking this down, the dividend detail is going to be part of this, but the manner in which it's detailed, I'm not sure. I would say go to learn more and kind of dig in. I'm not certain that the answer is right at your fingertips, though, to be quite honest for you. I'm sorry, I don't have a good answer there. I did want to utilize the scan tool to work in other groups, everybody, beyond communications. So let's move over to our industrials. So I'm just going to change the detail here. Instead of the communications, we're going to go into industrials. And I'm not going to get cute. I'm not going to look for a specific industry or sub-industry, but please recognize we absolutely could. You might want to, given the nature of industrials, it's pretty wide-ranging. So let's see if I go to select all industrials. There are 77. Now let's see what my scan is going to bring up, making sure that we have stock with sufficient volume, above a 20-day moving average, but also a 20 moving average above a 50 and a 50 above a 100. And this is a group that's been moving pretty well, so not at all shocked to see that we have some leaders in here, or certainly a larger list with which to work. What do we want to work with here, everybody? Do you want to see price to book value? I mean, that's kind of interesting in industrials. When you think about it, a lot of these industrial companies have to maintain a substantial amount of product, or maybe not product specifically, but huge industrial machinery, for example. That could be a part of their book values, which could tell you a little bit about things. We could base the decision on something other than a yield, even though industrial companies like these will pay dividends. Some of them don't, as you can see. We could also base it on just the trend, or maybe even the industry group, if that were the case. So a lot of options available to us. Let's click through, and we're going to lean into maybe my general approach to the market, which is to ensure the trend makes some sense. So we will go ahead. You know what? Instead of just clicking through, let me do this. I'm going to take that Kev Scan Thursday. Let's just go over here to personals. And we're just going to load my watch list from the Kev's Thursday. And then my expectation is to see some new, what I need to do is I need to save this. So this is, let's say Kev's Thursday with industrials. So here's how that might look. Oh, there it is. So here's Kev's Thursday industrials. This way, what's happening, everybody, as soon as I save this, all right, I can rescan if I want, but I don't need to. I'm going back into my personals. And there's Kev's Thursday Industrials. Now that list is refreshing every step of the way. That means I no longer need to use the scan on this. If, for example, I ever wanted to locate a stock from that scan, I can just load the watch list. And because that watch list has this bullseye icon with it, go to the proper one. There it is. See right here, the bullseye icon? That's a constant ongoing process for me. So I can absolutely use that list and it will refresh automatically or dynamically. Definitely a good way to go about things. Okay. You can limit your effort. Sarah, I'm sorry if we're going a little deeper today than we have. Yes, the list up above, you see a post from me, I don't know, about 10 posts ago. It has the caret and my KH moniker next to it. That is the playlist for this class. And you can go back and watch at your discretion and time any of the archived classes that we have here for you. That could be a little bit more introductory in nature, but recognize that we are happy to address those questions here live and in the moment if you've got something specific. Nothing wrong with that. Today, like I say, just a little bit more advanced and down the road, so to speak, from our initial introductions. But that playlist there would be a great thing to bookmark. Today's class will be added at some point early tomorrow, if not sooner. But a great way to go back is to check out that playlist and reference some of the older versions here where we have gone through some of this stuff in a little slower process. So I'm glad you asked, everybody. The YouTube page is a wonderful spot to continue your learning process at your time frame. So as I noted, everybody, we're just going to kind of move through here. We have a stock, one of them breaking out. Some of you would be interested based on a move to new highs. That's a possibility. So perhaps some Deere. General Dynamics is below a 200-day moving average. This could be acting as resistance. This is something that we definitely talked about in previous classes. Moving into resistance, some traders and investors would wait for the breakout to be a buyer. Like we had with Deere just a second ago, right? We just saw Deere moving through a new area and into a new area of price. That could be a good reason for consideration. Now, some of these are going to look a little different. There's GE. Why do we say Deere might be interesting? Having moved to new highs? Well, commonly when you take the lid off of a resistance zone, stock can continue to move. And here you go. There's GE continuing to move. LHX potentially moving through an area of resistance. Cintas potentially breaking out of what some traders might call a bit of a bull flag in here after moving to the upside already and consolidating, trying to do that. Based on what we've seen here, everybody, I think the one that makes some sense for us might be the Deere position. Let's just look at this on a weekly. All right, so you've got Deere moving in a former breakout and into a new potential breakout with the action we're getting this week. So that's a possibility. Yeah, I think that might be one. Now, granted, I know not everybody loves the idea of buying stocks at new highs, but one of my favorite reminders as it relates to the market, new highs are not bearish, everybody. I know it's difficult to be a buyer in stocks that are at highs. Doesn't mean you have to expose every dollar. Maybe we go smaller because it is a new high, but we don't want to discourage the idea of buying at new highs, especially when our key component in our process, everybody, is to make sure that we are buying stock for the purpose of allocating the investment dollars to a space in the market, more so than are we buying it at the most opportune time. The key component here in our discussion today is allocation of funds and participation in groups of the marketplace, more so than anything else. So we're going to go ahead and do a buy order, just a market buy for a whole 5 shares, which is going to get us into about a $2,600 position. Not substantial, but enough to get a little exposure. So there we go. We'll buy some Deere there. We'll move that into our our existing example portfolio. I'm going to make the adjustment so that Deere appears for me in my getting started allocation portfolio. There we go. All right. So we've taken a couple of steps today, everybody. Not a huge directional move, and I will have to go back in and update for myself how my example portfolio, the portfolio checkup here. And since I do have you all, just to highlight the ease with which we can do this, I'm going to go to portfolio setup, and I am going down here where you can see my external account. I'm going to modify that, and on the next page, it's going to ask me, what are we doing? So you can see I've already added details up here, everybody. I created a fake name for my other discount broker, and I'm just going to add more lines. So we just bought, nope, not that one. We've just bought some Deere. We bought a whole 5 shares, right? And we bought EA as well, and we bought 25. So now, as you can see, I'm adding just the share totals, and my approximations are coming through in terms of market value based on the current price action. So it's just detailing all of that. I'm going to go ahead and hit save and continue. So this is really, really easy, as you can see, everybody. And now when I look at my sector diversification tool, I have that a little bit of exposure. I got a little communications now, and I added some industrials now. Now I'm not as light as I once was, or I'm at, let's see, I'm at 5.5% when we want to be at 12 in industrial. So I will need to add to industrial, but you can see nothing is dramatically out of balance. Everything is relatively close, and set some ideas for yourself, everyone, as to how you'd like this to be. Hopefully that works here. Hopefully there's something you can take from today's segment on allocation, the use of the portfolio checkup tool. I'll remind you, I use this thing all the time. It's very, very helpful. You don't have to look at this on a weekly basis, even a monthly basis. I think keeping an eye on this maybe quarterly, even semi-annually, can be perfectly appropriate. If the market starts getting a little crazy one way or the other, maybe we get a really nice rally, and you're starting to think, hey, maybe I should check that out. Then it becomes maybe opportunity to just take a little bit of profits from those areas that have grown too quickly and apply them to the weaker areas. But, generally speaking, when it comes to reallocation of funds, the most important aspect is consistency when we do it. For a lot of investors, it's a one-time annual basis, and it's done with on a conversation with your local consultant in the branch, your financial consultant, your FC. So hopefully this is something that you all gained some knowledge from and some further understanding here. Always appreciate you all joining us for this. Big shout out to Mike Fairborn there. Thank you, Mike. Use that playlist, everybody, if you'd like to dig in deeper. And don't forget, Mike and I both, we're available on X for you as well. We do try to post for you throughout the week, but your questions can be brought to the X platform very easily if you're looking to connect with us outside of the classes that we host for you. Now, if you are catching this particular class in the archives, use the comments section down below the presentation window here. You can submit questions that way as well. Those will come to us and we can reply there also. So follow Mike and me on X at Kevin Horner CS, at Mike Fairborn CS. Hit that thumbs up button down below for me. That'll help me out immensely. And just have a great afternoon, everybody. I always appreciate you joining for the segments. I hope it is a good evening, and I look forward to seeing you all again real soon.